money accounts you can open, there are two most common accounts are a savings account and a checking account. A savings account is intended for you to put money into and let it accumulate rather than spending it. Financial institutions offer interest on the money you keep in your savings account, so it's a good incentive to keep something in there. This is what's known as a dividend rate. One type of account that has restrictions is a certificate of deposit, which is known as a share certificate at credit unions.
For these accounts, the member chooses a certain amount to be put into the account for a certain period of time. Then, the financial institution pays a higher dividend rate than if you had it in a regular savings account. The dividend rate that you receive will depend on how much you put in the account to begin with and how long your term is. The longer your term and the higher your balance, the higher your dividend rate will be. However, unlike savings accounts, which you can withdraw from at almost any time, you cannot withdraw funds from a share certificate or certificate of deposit until it reaches its maturity date. If you do withdraw the funds early, there will be a penalty based on how early you withdrew it. If you only have a savings account, you're a little more limited with how you can withdraw your funds than if you were to have a transactional account, like a checking account. You can withdraw cash or transfer money out of it in person at your financial institution. You can withdraw cash or transfer money at an ATM. You can make transfers via online banking or the mobile app, or you can set up an ACH transfer at your financial institution. This last one is best for recurring transfers or if you want to send the funds to an account at a different institution.
Unlike savings accounts, a checking account is meant to be transactional, meaning you use it for making more frequent transactions than a savings, like paying for goods and services. You can use your checking account to pay for things in multiple different ways.
One way is by writing a check. Checks are becoming less common as electronic payments become more popular. However, it's still good to know how to write a check and have a checkbook handy in case of an emergency. It's important that you complete a check in its entirety when you pay someone to ensure that they can negotiate it. If you do not, their financial institution might not accept it. A complete check includes the date the check was written, the payee, which is the person you're writing the check to, the numeric amount that you are paying, a written amount that matches the numeric amount. If the numbers don't match, this is the number the financial institution will honor, your signature, and if you want, you can write what the check is for in the memo line. This is mostly for your own notes so you'll remember why you wrote it, and it's not required. When you give a check to someone, it does not instantly come out of your bank account, so you need to make sure that you keep track of checks you've written so that you remember to keep that money in your account until it's negotiated. If you write checks very infrequently, you might be able to monitor your account and keep in mind that it's coming out soon. However, if you write a lot of checks, you'll want to adjust your checkbook ledger so you don't accidentally spend the money in your account that's meant for those checks. When you balance a checkbook, you start by writing down your starting balance. With each check that you write, you subtract that amount from your starting balance, and the money left over after this is known as your available balance. This is how much you have left to spend. The other money is technically still in your account and will show when you look at your account balance on your statement or if you look on your online banking. But those funds need to stay in there to cover the checks that you wrote. So if you want to buy something, you should only consider your available balance. Whenever a deposit is made in your checking or a check is negotiated, make sure to add those to your checkbook ledger so you always have your most current available balance. If you are the person who receives a check, take a glance while you're still with the person who gave it to you just to make sure it's complete so you can deposit it. When you're ready to negotiate it, you'll need to endorse the back. That means you need to sign in this section. Then you'll be able to cash or deposit it. As previously mentioned, checks are becoming less common as people are using more electronic methods of paying. One of these methods is using a debit card. A debit card looks like a credit card, but instead of getting a bill that you need to pay off every month, it is linked to your checking account and immediately communicates the payment to your account. Many people favor debit cards over checks nowadays because then they don't have to wait for the payment to show up in their account. Another method is using a payment app like Venmo, PayPal, or Zelle. To use these, you save your debit card information or bank account information in the app, and then you can make payments to websites or other people using the app. We recommend entering your card info and not your bank account info for security reasons, just because it's easier to close your card and get a new one than to close your account and open a whole new account. Similarly, Apple Pay, Samsung Pay, and Google Pay allow you to save your card information and then hold your phone up to compatible payment terminals. These are a lot more secure than using other cash payment apps. Many financial institutions, like the Michigan Tech Employees Federal Credit Union, have bill pay integrated into their online banking, and this offers yet another way to pay from your account electronically. You set up a payee, either a person or a business, by entering their account and financial institution information, and then you can initiate payments at your leisure, or even set up automatic ones.
Then, if you set up the payee to receive an electronic payment method, such as by text, email, or direct deposit, the funds will be removed from your account right after you initiate the payment, and they will be sent to the payee in the specified manner. The payee will usually receive these funds in 1 to 2 business days. If you set up the payee to receive a non-electronic payment, such as by check, the funds will still be withdrawn from your account right after you initiate the payment, but the system will automatically cut and mail a check to the payee. If you're using this method to pay a loan or make a deposit to your account at another institution, please note that it may take several days because the check needs to be cut, mailed, and processed by the other institution before it'll show up on your account there.
If you have any questions about savings or checking accounts, please reach out to our Member Service Department at the Michigan Tech Employees Federal Credit Union. They're happy to help answer any questions that you might have and get you set up with an account if you'd like one. Continue these lessons with Session 3, Saving More and Spending Smarter.